Hello everyone, welcome to the market snapshots for today. So overall the markets have been really bad, and I think if at all you have been following me, it's been almost a month ever since I have been telling the exposure should not be more than 50-60%, although the markets keep showing that they're moving ahead, then going back, moving ahead, going back, but then overall somehow the data points have not been in sync with the rise or the fall, and that is the reason I have consistently pointed that the exposure cannot be more than 50-60% in both the markets, be it the US or the Indian markets. This is something which at least I don't see a lot of people talk about. People will only tell you which stocks to be bought. I mean, that is the only thing which I have heard on most of the social media platforms, wherein people just talk about what should be bought. Honestly, like that is the easiest bit to tell in markets what needs to be bought. The difficulty is whatever you have bought, when do you exit that? The second point is it is very important or critical to understand that markets are not only about what needs to be bought, but at the same time when to be bought and when not to be bought. Because see, if you look at the best of the investors, they have mostly averaged at around 20% CAGR, 24%, 25% CAGR. And honestly, getting that kind of percentage is not difficult. Even you can achieve with slight bit of patience and work around it. I think the biggest advantage with most of the greatest investors have had is that they always knew when to participate in the market and when not to. See, the moment you make a 25% and you don't let it go away from your trading accounts, that itself is a victory. You made 50% but let almost 80% of that just drain away. So eventually you never made any money, because next time uh, you know when you start making money, you are almost 80% down on your capital, and the recovery itself will take away most of the gain. So how, like, there is no point that you'll eventually be able to compound your wealth. So I think this is very critical. That is what I want to start with today. And looking at the markets, Nifty 50 looks poor at 23,767. Nifty 500 looks poor at 22,968. US 100, that is Nasdaq 100, looks poor at 28,128. And S&P 500 looks decent amongst the four at 7412. This is advances to declines. Nifty 500 236 advances to 264 declines. This is Nifty 500. New highs 7 to new lows 493. Breadth terrible, up below above 20 ma, 165 stocks, above 50 ma 258 stocks, above 200 ma 265 stocks. The chart, I mean, Nifty 50 looks like poor. If you see, I mean, has gone below 50 ma. I think it is time to be in cash. If at all you want to still be a participant in the market, the exposure cannot be more than 20-25%. I think till my last session, I have, for almost a month, I have said the exposure cannot be more than 50-60%. At this point of time, either you shouldn't be making new position, or if at all you want to, the exposure cannot be more than 20-25%. That is for sure. Nifty 500, same story. It has gone below 500, although the 50 ma looks bullish, but it is trading below 50 ma. So time to become very cautious. Either it's a no trade, or maybe with an exposure of 20-25%, nothing more than that. I mean, new positions cannot be more than with more than 20-25% of exposure. Overall, the market sentiments, if we look at Nifty 50, looks bearish below 50 ma. Participation is weak, breadth is weak. Nifty 500 bearish below 50 ma, participation mixed, and breadth weak. So overall, for the Indian markets, I would say either you shouldn't be making new positions, and if at all you are making new positions, the exposure cannot be more than 20-25%. If at all you had heard me, if you were following me from almost a month or so, a lot of money you would have saved in this fall. But then if at all you have not been listening, I think you can at least try to listen, and maybe matter of time, you'll see your results itself. And this is not a buy or sell recommendation, but this is purely what is the market is telling, and we just try to react to that. I'm not someone who predicts if the market will go up or the will go down. Basically, I collate my own set of data, and that helps me to understand if it is time to be in the market, or avoid or being in cash. So my current study or analysis says it is time to remain cash. If at all I want to be in positions, it cannot be more than 20-25% of exposure. At this point of time, I'm not making any new positions for myself in the Indian markets. This is S&P 500. The advance is 366 to declines of 134. Again, if you remember, it's been almost a month I have been saying the only index which looks good to decent is S&P 500. And somehow, is it the best? For sure, no. But it is good amongst whatever we see on a regular basis. The new high is 26 against new lows of 474. The breadth here is pretty decent. Above 20 MA 277 stocks, above 50 MA 329 stocks, above 200 MA 324 stocks. Uh, this is Nasdaq 100. The chart has gone bearish. I mean, if you remember, I think 3rd of June is when I said I was not making any new positions. Not even 3rd of June. I think almost after 20th of May, I had stopped making any new positions in Nasdaq 100, just because this entire rise was not in sync with the data, and hence that's the reason. So that is what I'm saying. See, if at all this rally was enjoyed, it is not bad. The market might have gone, maybe I started telling here somewhere here that the rise is not in sync with the data. And if at all new positions were not made, this entire bit you could have saved. Did I predict the top? No, I did not, because I think somewhere here my data started telling this rise is not supportive. So that is what I am saying. So I don't think there is any way wherein we can predict a top or bottom. But then if at all we rely on the data, data itself tells you that whether this rise is has some strength, or is it just rising on its own, trying to trap. I think I remember in one of my videos I told like these rises just made to hand over the tops to the retailers, and that is what exactly Nasdaq 100 did, and it never breached this level. Anyways, coming back, S&P 500. This is the best looking chart to me. Not, I mean, the bias is not only the chart, the major bias is towards the data, and the data suggests that S&P 500 is stronger amongst everything else which I look at. Russell 2000 again has gone little bearish. The data has not been supportive of the rise, and that's the reason no new positions I'm making even in Russell 2000. So what is the overall picture of the US markets? Nasdaq 100 bearish, below 50 MA, participation is mixed, breadth is mixed, weak. So basic for sure there has to be no positions in Nasdaq 100 at this point of time. S&P 500 bullish, participation is strong, breadth is mixed. Okay, I want to emphasize something here. Till last week, I think I have stated that the exposure can be around 50-60%. At this point of time, although S&P looks the strongest amongst everything which I look at, but at the same time, the exposure cannot be more than 25-30%, because a lot of participation breadth has deteriorated, and a lot of money is moving towards defensive sectors, and that's the reason S&P 500 should be your bet, but the exposure cannot be more than 25-30%. Russell 2000, I think you can avoid for now. At least with my perspective, it doesn't looks good. So what is causing all the biggest problems? I think this is what I have been highlighting. I mean, I don't know, almost for a month. The yields are rising at 4.68. If this is a very, very critical level. If you remember, I have stated that if a monthly close of 4.6 and above happens for US 10-year yields, we are looking for very bad times for US equities or Indian equities. And that is where, it's already 26th of July, and that is where US 10-year yields are hovering. Not a very good sign for the equities markets. And that's the reason, it is not that I just look at certain data on the equities market or or the charts. I think, these are very, very important factors which tell you where the money is moving. And if money is not moving towards equity, you and I cannot move the markets. That is for sure. So money is moving towards yields. That is what the yields are suggesting. Dollar at 101 0.46 is definitely not supportive of the rise of equities, and that's the reason that creates a double pressure on the equity markets globally. VIX at 18.58 suggests that everything is neutral, which is not. So that is the reason a lot of people feel VIX will tell you above 20. When VIX goes above 20, things are becoming dicey. But VIX has remained between 15, 16, 18, and a lot of things have changed. That is what I'm trying to tell. Markets are not about one definite data point you look at and then decide this is what needs to be done. I think a lot of things are related, and when you look at those, a lot of points, try to connect the dots, that is when you get some sort of indications from the market. Bitcoin at 450 again. hmm, this has also risen. This is also a very contradictory fact. Bitcoin was around 58 60,000. It has already risen almost 4,000. Very contradictory type of scenarios all across. Bitcoin is rising, yields are rising, dollar is rising, VIX is saying new things are neutral, and equities, the breakouts are not working. So that's the reason I'm telling you the exposure cannot be more than 25-30% in the US market or the Indian markets. For the Indian markets, I think you can be in cash. That could also be a good call. But then the overall the exposure cannot be more than 25-30%. That is what I would say. Gold at 4052. I think a lot of things are happening in gold. A lot of central banks are accumulating at its highest levels the gold. So a lot of fundamental or macro investors are of the belief that mm, gold can still rally a lot. And what I have studied or found from the markets is, trends don't fade away with a rise of 6 months, 12 months. Trends literally persist much longer than what we anticipate. But because I do a lot of mixed bag of things, I follow trend also, I follow market data also, and I study a little bit of macro. For me at this point of time, I'm not getting into gold, but then a lot of accumulation is happening in gold, is what at least the central bank data suggests. Dollar, just look at it. It is trading its highest level, which is obviously not good signs for equities markets across globe, and that is what is creating a lot of pressure, and that is the reason I have been emphasizing either it has to be cash or the exposure cannot be more than 20-25% for the equities market. Bitcoin, again, a very contradictory scenario happening here. It has risen almost 4 6,000 points, and basically, it indicated somewhere here that the market sentiments were becoming positive. But then again, I think we'll have to wait and watch what happens in Bitcoin. At this point of time, it is just gone sideways. You can avoid trading Bitcoins. Gold, this is what the macro players are saying, the fundamentals, that it is getting accumulated at around these levels. A lot of central banks have almost doubled uh, their buying powers in terms of gold. At least to me, till the time everything aligns, I'm not going to get into gold. But fundamentally, a lot of accumulation is happening in gold. That is what it is. uh, so overall, the sectors, so I'll tell you, these things have not changed. It is as like simply the same which we discussed last week. I have been telling the money is moving towards defensive sectors, and that is what exactly is having. The only difference is this week consumer durables has topped this table, but I intentionally did not change it. The reason being, I wanted to tell you that money is moving towards defensive sectors like health, reality, and consumer durables in Indian markets, and the story is same for the US markets. These are the same sectors which we got last week. We have the same this week. The only difference, energy here tops for the US markets and consumer durables tops here for the Indian markets. Intentionally I have not changed, just to tell you that it is the same chart and the money is moving towards defensive sectors. The strongest looking charts from the Indian markets are Loris Lab, Federal Bank, Manappuram, Titan, Fluorochem, and from the US market, GTLS, MET, PKG, JPM, TMHSC. So so overall, the plan is just go and buy all these stocks tomorrow. Please don't do that. These are not buy sell recommendations. I feel these are strongest stocks in the market at this point of time. Second bit, the exposure cannot be more than 25-30% in either of the markets, because if at all you are doing that, uh, you are definitely not doing any word of good for yourself, because markets are terrible. You need to trust me. There is enough data points which I have keep discussing that markets are not going to be very favorable. So breakouts will not work. You will be handed over the tops of a lot of stocks. So be very, very mindful, be very cautious, get into sectoral indices, look into strengths where the strength lies. And that is when, if at all you cannot live without trading, you need to, put your 20%, 15%, 10%. That is how you should be planning your bets. So overall, I think overall for the Indian markets, I think cash could be a good position. You should not, you can definitely hold on to whatever you are holding. Look at your stop losses. And third thing is, if at all you are willing to trade, the exposure cannot be more than 25-30%. Coming to the US markets, same story. The strength lies with only S&P 500, at least for me, uh, into defensive sectors, and then with an exposure of not more than 25-30%. Uh, you can keep looking at gold, because a lot of macro factors are working in favor of gold. But then for sure, whenever gold turns, I'll also, I keep looking at that chart. I'll definitely let you know. Bitcoin is also something which you can watch out, because it is one of the primary indicators, which tells the market sentiments in terms of risk appetite of the investors. So overall, I think it is good time to remain in cash or with an exposure of 25-30%. Dollar needs to be checked regularly. US 10-year yields needs to be checked regularly. Uh, don't gamble. Don't lose your money for no reason. It is very, very critical that you realize markets is all about knowing when to be in the market and when not to be in the markets. It is not only about making a 50%, 80% return, because if at all consistently you can do a 20-25% and you know how to save that 20-25%, eventually you will compound much faster than a lot of people. So overall takeaway is, be very, very cautious at this point of time. Keep looking at the macro picture, keep looking at the overall indices. I think defensive sectors are the where the strength lies. And yes, that's everything from my side. I hope you all found this useful. Thank you so much and see you next time. Have a good one.